All right. Today is Wednesday, April 6th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, but without further ado, here it is, in focus. Don't fight the Fed. The Fed wants to crash the stock market. Let them do it. The main event that we got today is the FOMC minutes, which the bulls were placing a lot of hope on. The problem is the Fed's minutes came out to actually affirm the hawkish stance that we've been hearing from various Fed officials. Most importantly, the FOMC minutes now confirm that the Fed will start to undo the balance sheet by the tune of $5 billion a month. That is a lot. And most importantly, the Fed has been buying mortgage-backed securities for years now. The question is, as mortgage rates start to move higher and the housing market starts to cool down, prices go down, what will happen to the Fed's holdings? Are they going to start to lose money as they dump? An important question we must all ask because it will have massive ramifications. The Fed, of all people, is about to hold the bag. What are the implications of that on the broader economy? But I want to rewind and go back to Jerome Powell because he's the captain of the Titanic. He got us here by his lousy decisions, an obsession with the stock market performance. How did we get to this inflation crisis? Everybody's talking about inflation now. It's a household issue. It's a kitchen table conversation. We've been talking about inflation in this channel for over a year now. We've been warning and warning and warning. Inflation is not transitory. It's going to morph into a global crisis. And this is what we're seeing right now. How did we get there? A lot of garbage out there. It's Biden's fault. It's Putin's fault. It's because Mars and Jupiter didn't align the right way. It's because gas companies are price gouging. It is because we ran out of farts in a jar. Whatever it is, it's all garbage. Inflation has always been a monetary phenomenon, meaning the Fed is the sole responsible party for this inflation. How did the Fed get it wrong? Well, let's go back and hear your boy Jerome Powell when he decided to let inflation go. And he didn't even bother to use a formula. Yep.
In seeking to achieve inflation at average percent over time, we are not tying ourselves to a particular mathematical formula that defines the average. Thus, our approach could be viewed as a flexible form of average inflation targeting.
In other words, Mr. Powell said, I'm going to let inflation run a little high, but I'm not using any guidelines or formulas or any of that boring stuff. I'm just going to eyeball inflation. Can you imagine if you're a kid at school or college and when you do your homework or final examination, you tell your teacher, hey, I'm not going to use a formula or any math or anything like that. I'm just going to eyeball it for you. You think that's going to pass? Because this is what the Fed chairman did. Let's just eyeball inflation and see how it goes. And we've been warning and warning and warning in this channel that this will lead to a disaster. And what did the Biden administration do? They renominated this moron, Jerome Powell. And speaking of the BlackRock administration, today Brian Deese, who is a graduate from BlackRock, currently works at the Biden administration like many others, and therefore we call it the BlackRock administration. What could go wrong, right? When we hire all of these BlackRocks and Goldman Sachs and JP Morgan at the government, what could go wrong? You think their interest is going to be aligned with the people or with their former employers? Anyhow, Brian Deese now admits that the U.S. will lose at least 1 percentage point in GDP due to the chip shortage. In other words, Brian Deese now admits that the U.S. economy is now going to slip into stagflation. And oh, by the way, he's telling you ahead of time to sell all of your semiconductor stocks. They're not going to do good. Why? They don't have any supply to sell. Maybe the demand is here, but they don't have any inventory to sell. The revenues will be down, the profits will be down. The party's over, folks. But two most important developments that happened today from the Fed, one from Philadelphia Fed President Harker and former New York Fed President Bill Dudley. We start with Harker because Harker kept saying last year, inflation is going to be transitory. Don't worry about inflation. We got it. Papa Jerome got it. And now he says, oh, it's not going to be transitory. Matter of fact, oil prices, higher oil prices that is, might be with us for a little while. So we went from transitory to a little while. What is a little while, Mr. Harker? Oh, it could be a month, could be 6 months, could be a year, could be to infinity and beyond. Now, mind you, Harker is part of the doves. And he came out today. Yesterday we got brain dead. One dove turned into a hawk. Here's another one. Harker now says he's acutely concerned about inflation and sees deliberate rate hikes. Harker also added that inflation is far too high, and steady rate increases and balance sheet reduction should help ease price pressures over the next few years. Wow. So inflation went from transitory to, oh, you gotta wait a few years before it goes down. And let's hear this interview with Harker. This is just about a week ago when he was still, shall we say, keeping some of his dove feathers. Let's take a listen.
And how aggressive should that look? Because we don't hear as much about the balance sheet shrinking.
Yeah. So my view on the balance sheet is we start on the process of reducing the size and then put it on autopilot, not use that as a tool of monetary policy. It's hard to do policy with two things moving at the same time. Let's put the balance sheet normalization on autopilot, and then we can adjust, if necessary, the Fed funds rate going
I don't think
forward.
the market likes that whole idea of balance sheet normalization on autopilot. Wasn't that a sort of communication error the last time that happened? Doesn't it have to depend on what happens with the markets and the economy?
Listen to her. Don't we have to wait to see how the market's going to react? Because last time around, when you announced the autopilot policy, the stock market went down. Should we kind of still be worried about the stock market performance before we do anything right about the economy? Folks, this obsession with the stock market, it's a culture within the Fed. Every Fed president, matter of fact, Jerome Powell, has the stock market chart on a monitor live. They have an obsession with the stock market, and this is blinding them from making right decisions about the economy. It certainly blinded them when they initiated the cocaine operation, the trillions of dollars of liquidity that was not needed, by the way. The economy and the stock market panicked in the crash of 2020 because we did not know what the thing is, or what the implications are going to be. And the Fed overreacted and oversupplied the economy with money. And now we have too much money chasing few goods, hence inflation. And they're still obsessed with the stock market. You want to solve this whole problem, shut down these monitors and stop looking at the stock market. Look at the economy. Talk to people in the economy. How do you feel about your rent going higher by 25%? How do you feel about prices at the gas pump? How do you feel about prices at the grocery store? And of course, the answer is going to be not so hot so. But the alternative from the Fed right now, the Fed will follow up and say, well, how do you feel if you lose your job? You see the blackmailing now? They created this problem. And the solution right now is dipping the economy into a recession. So if you don't like inflation, would you like to lose your job, ma'am, sir? And now people are put in this position, unfortunate position, to choose. Do they want endless inflation, where at some point you're going to work and your salary is not going to be sufficient to pay for rent, gas, groceries, utilities? Or you lose your job and inflation goes down and good luck. It's a shitty situation either way. But guess who's not going to be impacted by all of that? The corporate insiders, the billionaires, the 1% who benefited from the pumping of the stock market and they sold at the top, and now they have a mountain of cash to weather the storm. Ask yourself a question. Do you have the mountain of cash to weather the storm in case you lose your job? Of course not. Are you getting engaged in risky behaviors, such as investing in tulips and meme stocks and stupidity? You better wake up now and start building a cushion when the time, not if, but when the time comes and you lose your job. Continuing.
We can use the Fed funds rate to adjust appropriately. I think in this case, we should communicate early, often what we're going to do. We're just finalizing that plan, and then we execute it. I don't think we should play around with it month to month.
I'm sort of surprised that you're not there yet on a 50 basis point hike next meeting, because I feel like a lot of your colleagues are getting there.
Yeah.
And there's a realization that the Fed's kind of behind on the inflation fight.
I'm not taking it off the table at all. I mean, in fact, I'm quite open to the idea of a 50 basis point. Let's see what the next inflation reading comes out. Also, the details of how we're going to be normalizing the balance sheet, because that will matter too.
Yeah, I'm open to 50 basis points hikes, but let's see how the stock market reacts first. Let's see how the inflation data is going to come out, really. They're still obsessed with the stock market, number one. Number two, at this stage, if you're still going to wait and see what the next CPI reading is, you haven't got the memo yet. Matter of fact, you shouldn't be doing this job. At this point, Mr. Harker, you should have already came to the realization that inflation is not going to stop on its own. You don't have to wait for next month's reading to wait and see whether inflation is going to be transitory. You're still obsessed with transitory. At this point, it should be clear to you that inflation is going to continue to go higher. Be it commodities prices moving higher, be it inflation expectations moving higher, be it wage inflation moving higher, be it the scarcity of supply still with us, be it the easy money policy still with us. People are still gambling on meme stocks and cryptos. It should be clear to you that inflation is not going to stop right now. And the fact that you don't realize that makes you unqualified to be a Fed president. Continuing.
Inversion of the yield curve. It's happening.
Yeah.
What does that signal to you? How much do you care?
So the evidence is mixed, right? If you look at the data, it clearly is correlated with recessions, but causation is not very clear.
Yeah, causation is not really clear. Oh, really? 50 years plus worth of data, and it's mixed and it's not clear? Again, how the hell do these people get to keep their jobs?
So we need to make sure that we're looking at lots of different data. We are starting this process of raising rates and removing accommodation with a very healthy economy absent the inflation numbers. You just look at the jobs numbers we're seeing, including those today. This is a strong position we're in. So I think we can't always use history with respect to the yield curve as the sole measure. Is it a measure? Absolutely, but not the measure.
But I feel like the concern is actually that the Fed, that you guys are going to overdo it when it comes to hiking interest rates to fight inflation and sink us into recession.
So that's why I'm still open to 25 versus 50 next month. And I think we need to be careful about this, that we don't ruin a good economy otherwise, except for inflation.
Yeah, it's a great economy, with the exception of that little thingy, that we call inflation. We don't want to ruin a good economy, buddy. The Fed and their allies, they don't care about inflation because inflation is just a annoyance to them. It's just a tiny, small, little problem. It doesn't really impact them. It impacts them in the only way, which is they have to hear the poor and the middle class complaining about inflation. So to them, why would we crash the stock market? Why would we crash real estate values? Because of inflation? Deal with it. What's wrong with you poor and middle class people? I say inflation is a big problem, Hawker, because if it continues to go on, at some point, it's not going to make sense to work anymore. You're spending your time 9 to 5, and you cannot even afford rent, groceries, gas, utilities. What is the point? Might as well sit at home and cash some government checks. If we let inflation go rampant, the only reason people would be working is because they have no other choice. They're working knowing that they're losing money, but they don't have other choice because they have to pay all these bills and keep up with the inflation going around them. Is that really a good economy, or are the pitchforks about to come out?
We'll see.
When do you think inflation peaks?
Yeah, so
Yeah, so I wouldn't be asking this guy, when will inflation peak? This is the same guy who kept telling us it's going to be transitory. I wouldn't even trust this guy with the time. If I ask this guy, what time is it right now? I wouldn't trust the answer. But perhaps the big bomb that we got today was from former New York Fed president, I should say, Bill Dudley, who said that the Fed must inflict more losses on stock investors to tame inflation. What is he talking about? Before we do that, let's go back to Dudley's interview about a week ago when he pretty much shredded the soft landing fantasy to little pieces, exposed that the soft landing fantasy is garbage. Take a listen.
Can we avoid a recession and get inflation under control?
And of course, what David Weston is asking right now is, can I snort a mountain of cocaine in a single night and not overdose, Mr. Dudley? And if I overdose after snorting a mountain of cocaine, is it possible that I'm not going to die?
It's theoretically possible, but history is not very kind. Chairman Powell cited 3 episodes where the Fed tightened and we had a soft landing, 1965. 1984 and 1994-95. The problem is none of those episodes are really relevant to the current situation because in all those episodes, the Fed tightened, but not enough to slow down, keep the unemployment rate from declining.
And the 1994 example, which was a soft landing, is not applicable here for an important reason. Inflation back then wasn't even close to what it is right now.
In all 3 of those cases, the unemployment rate kept falling, and we can't afford to let the unemployment rate continue to fall in the current environment because all that would do is push inflation even higher. So the chances of generating a soft landing, it seems very remote. Because the economy, if you start to push up the unemployment rate, it's very hard to control that process. There's a rule called the SOM rule, which basically says every time the unemployment rate goes up by more than 0.5 percentage point, the next stop is a full-blown recession. And a full-blown recession is not a rise of 0.5% or 1% in the unemployment rate. The smallest rise in the unemployment rate we've seen in the post-World War II period is over 2 percentage points. So I think it's going to be very difficult for the Fed to pull this off. Obviously, they should try to pull it off, but it's going to be very difficult for them to pull it off.
Okay, let's address some of what he said because it appears as if he's cheerleading for job losses, for the unemployment rate to go higher. Not true. But this is a common thinking right now. Even Nancy Pelosi came out and said, yeah, the inflation problem is happening due to low unemployment. So Nancy's repeating the Phillips curve garbage, which was debunked, by the way, more than 60 years ago. Low unemployment in itself doesn't cause inflation. You could have low unemployment in the economy and not have inflation. We had these periods before, by the way. And it happens when you have organic growth in the economy, a bottom-up approach, small businesses creating jobs, entrepreneurs creating jobs, healthy expansion of companies creating jobs. This is not what we have right now in this great economy, quote unquote, that Harker is bragging about. What we have right now is the Fed flooding the system with cocaine, with endless liquidity, trillions and trillions of dollars, stimulating fake demand in the economy. And demand soared to insane levels because a lot of these trillions landed in the stock market and cryptos and all of that, and that exacerbates the wealth effect that people have. And they start taking loans and credit card debt and buying stuff. On top of that, a lot of that money landed in stimulus, and people used that money in the form of demand in the economy, excess demand. So the companies now have to respond to this excess demand. There's a lot of business. Business is booming, even if it is fake. We have to respond and hire people to expand and respond to this demand. So all of these companies are hiring people to respond to the fake demand. And when you have the pool of employees limited because everybody has an abundance of money and excess reserves and all of that from the insane money printing, you have to pay higher wages. And when you have a competition between Amazon, Walmart, and many other employers, you have a spiral of wage inflation, and companies hire first, ask questions later. So we see wages rising higher, inflation moving higher, and the unemployment level moving down. But at some point, when inflation gets out of whack, out of control, the Fed has to tighten and has to serve the red pill to the economy. Hey folks, sorry, we oversupplied the market and the economy with cocaine, and all of what you see around you is fake, except the gains in the stock market and the real estate market that the insiders and the 1% locked in by dumping their stocks and their real estate portfolios. So we have to take all of that pipe dream out, and now this will cause a stock market crash. Employers are going to start to get rid of excess employees because the demand is being eroded in the economy, and we dip into a recession. And this is what happens when you build a fake economy based on money printing. But you can have an organic economy with a lot of growth, low unemployment, and very low inflation. That has to happen after the reset when we build the economy organically. But that doesn't appear to be the case because they're talking right now that after the recession happens, the Fed is going to start easing again. So we're going to go back to the Fed's engineering of the financial system and the economy. The same mistakes over and over and over again. But today, the explosive interview with Dudley, where he pretty much admitted and laid it out there that for now, for the Fed to tackle inflation, it will require crashing the stock market. Take a listen.
Your line in your piece this morning in the lead paragraph, Bill, I think has got everyone's attention, so I'll repeat it for everybody who hasn't heard it so far. To be effective, it'll have to inflict more losses on stock and bond investors than it has so far. Bill, run us through financial conditions and how you gauge financial conditions and why you might believe that stocks are a big part of that.
Well, financial conditions are important in the United States, and Chair Powell has emphasized this in his prepared remarks because that's how monetary policy works. The U.S. economy doesn't really run on short-term interest rates. It really runs on long-term interest rates, and the stock market is also important because a lot of people have exposure to the stock market, and the level of the stock market affects their wealth. So the Fed has said pretty clearly we need to tighten financial conditions to slow the economy down to keep inflation in check. And so far, financial conditions really haven't tightened very much. The stock market is only 4% or so off its high. It's still up very sharply from where it was a couple of years ago. And bond yields, 2.5, 2.6%, are still really low, especially when you adjust for inflation. So in my mind, the Fed hasn't really accomplished much yet. And if financial conditions don't cooperate with the Fed's going to have to do more until financial markets do cooperate.
Okay, let's translate. And by the way, I'm just going to serve it to you. I'm not going to sugarcoat anything here because when I go to the doctor and say, hey, doc, do I have cancer or not? I want to hear yes or no. I don't want to hear, yeah, well, you have some medical challenges in the next few months. Do I have it or not? And the same thing goes to this. I'm going to serve it to you straight. What do you think tightening the monetary policy means? What do you think when you hear the Fed is about to tighten financial conditions? What do you think that means? In a nutshell, it means, number one, higher unemployment. It means stock market losses, meaning a crash, because you got to slow down the demand in the economy. And the demand in the economy is not going to slow down without job losses and rattling the confidence by crashing the stock market. All of that's going to lead to slower demand, which will lead to slower growth, which will lead to a recession. That's how it is. No sugarcoating at all. Now, you might argue, is it ethical or perhaps the right thing for the Fed at this stage to erode the demand in the economy by causing higher unemployment and crashing the stock market? Why would they do that? This is the part where the discussion about the red pill and the blue pill comes. You have economists like Mohamed El-Arian, for example, who says we're going to take the blue pill. We better have higher inflation and let it run off rather than causing a recession, higher unemployment, and a stock market crash. I disagree because you got to take the red pill right now because the economy still has the cushion to absorb the shock to a certain degree. Yes, the stock market will go down. Yes, we might see some job losses. But if we do it right now aggressively at this stage, inflation will be tamed down significantly at some point, perhaps by the end of the year or early next year, and we can rebuild the economy again with minimal damage done. But if we wait till the inflation problem becomes stagflation or hyperinflation, or we see people struggling to pay rents, groceries, gas, utilities, it's going to get a lot uglier. And at some point, sooner or later, the Fed will have to realize and come to the conclusion that they have to slam on the brakes either way to kill inflation. But at that stage, the economy is not going to have the cushion to absorb the shock. And we could dip from a recession to a depression. And this is my take. Back to Bill Dudley.
Bill, talk a little bit about the consequences of this. If stocks are a reflection of sentiment, if they affect the way that people are willing to go out and make purchases based on their household wealth, what does that do to the economy? Are you basically saying that if things continue the way they are, the Fed is going to have to torpedo growth to a potentially recessionary degree?
Well, the Fed right now is, markets are pretty confident in the Fed's program because they have the Fed taking the short-term rates up to about 3%. That causes the economy to slow, and then the Federal Reserve eases policy in 2024 and 2025, and we have a soft landing and live happily ever after. I don't think it's going to be that easy because the markets are so confident in the Fed, the financial conditions are still quite buoyant. If financial conditions are buoyant, that means the Fed has to do more to slow down the economy. Also, a soft landing is very, very hard to achieve when the unemployment rate is so low. The soft landing examples that Powell has cited, 1965, 1984, 1994, were all examples where the Fed tightened and the economy slowed, but did not slow sufficiently to push up the unemployment rate. The unemployment rate in all three of those episodes kept declining. I think in the current environment with the unemployment rate at 3.6% and wages running well above a rate consistent with 2% inflation, the Fed's going to have to tighten enough to tighten financial conditions enough to push up the unemployment rate. And when the Fed has done that in the past, it's always resulted in a recession. That's not their intention. They'll go for a soft landing, but their chances of pulling off are very, very low.
In other words, when the Fed raises interest rates, that alone is not going to tackle inflation. So when people, the morons, the pumpers, say, oh, the stock market is pricing that in already. No, it's not. The stock market would price that in if it goes down 20, 30%. Meaning, if the Fed continues to raise rates, but the stock market remains elevated, then inflation is not going to go away at all because you have the wealth effect and people will have the comfort and the cushion to continue spending in the economy and causing that demand to soar again, which will cause inflation to stay elevated. What I'm trying to say here, folks, and what Dudley is trying to say, don't fight the Fed. To accomplish their goals in tackling inflation, the Fed must crash the stock market. The stock market must go another 20, 30, if not 40% before we get inflation out of the system entirely. And of course, when that happens, we get to the conversation, is the Fed overdoing it with the tightening or not? This is the same Fed who eyeballed inflation when it was pushing it higher. No formulas whatsoever. And now it's going to eyeball tightening the monetary policy. No formulas, no guidelines whatsoever. What could go wrong, folks? So if the Fed wants another 20% crash in the stock market to tighten those financial conditions, you got to remember, they're not using a formula. They're not using any science to guide the tightening. They're using eyeballs. So that crash could morph from 20, 25% to 40, 50%. This is the risk that you're taking right now in buying the dip.
Do you think that rapidly reducing the balance sheet, Bill, will be enough to achieve this sell-off that you think is necessary in order to enact some of the tightening that the Fed is trying to achieve?
Well, certainly we'll work in the right direction. Obviously, quantitative easing helped cool down long-term yields, and I think as you reverse course, that should push them up. But we don't know by how much. we already know what the Fed's going to do, and markets haven't really moved very much. So, I think it's just a big wild card in terms of how much will the quantitative tightening do the Fed's job for them. I think the big point I would just make is just it's very unlikely that a year from now we're going to be at this level of bond yields this low and this level of stock prices this high, because that's probably not sufficiently tight financial conditions to do the Fed's job for them.
But hey, rest assured, if you're scared by Dudley's comments, you know what the bulls are placing their hopes on these days? Magic. Yep, if the Fed is against you, if the macro environment is against you, if corporate earnings are against you, if the consumer spending habits are against you, if consumer sentiment is against you, why not rely on faith and magic? Let's go to the psychic down the street and get some tickers. When the bulls are that desperate, we got a problem, folks. You know why we got a problem? Listen to Goldman Sachs' Costin, who we talked about in yesterday's video.
Yields are flying. They've been surging through March. We've got hawks all over the place and big tech has rallied. Walk me through piece by piece why this has been happening from your perspective.
Well, there's a concern about a upcoming recession. It's not the Goldman Sachs economic forecast, but certainly in the minds of many portfolio managers, that is a increasing risk. And that is one of the reasons why their attractiveness of some of the largest technology stocks and some of the more durable earnings companies in many different sectors, but we'll focus on tech for just a minute. And I believe that is a key kind of underpinning thesis for why the stocks have done well. We are about to embark on the first quarter earnings season that will kick off around April 11th or so. And I believe that there's going to be a significant number of negative earnings surprises. In fact, you probably get a large number of pre-announcements in the coming weeks just before the earnings season.
Bingo. Bingo. What's going to happen right now, because companies know that this quarter is going to be lousy, this earnings season is going to be a disaster. So instead of waiting for the earnings to come out and then watch their stocks go down 30-50%, they're going to get the bad news ahead of time. In the next few days, expect companies to say, hey folks, by the way, those earnings we're about to announce, yeah, they're not going to be good. And the hope is the stock goes down 8, 9, 10%. And then comes the shock of earnings and the stock is already priced that in. Or the shock is going to be absorbed because the stock already went down 8, 9, 10% when we announced the bad news ahead of time. Not a good environment here, folks. And the bottom line of all of this story is the Fed created inflation by the reckless policies, by pumping stocks and the real estate markets. And now they're going to crash the economy, cause a lot of unemployment and a stock market crash to clean up the mess that they created. And in all of this ride, up and then down, the rise and fall of the everything bubble, who ends up being a winner? The insiders, the 1%, the billionaires. They got a lot richer and they sold their stocks and real estate portfolios at the top. They locked in that wealth. And when the economy crashes, and asset prices go down, now they get to scoop them back at a cheaper price and concentrate their wealth even more in this economy. The loser, on the other hand, is us, regular folks. Like a bunch of morons, we celebrate in the beginning, our wages go higher, our stonks go higher, our tulips go higher, we're rich, baby, and then everything goes down. We lose our jobs, we lose our stock gains, we lose our tulip gains, we lose everything. And this is why in this channel I've been teaching you all of this to protect you, to help you make sound financial decisions and not be another victim of this financial engineering and the crimes by the Federal Reserve. Anyhow, folks, we're going to move on here. We're running out of time. We got to cover the market information for you. We start with the performance of indices today, and here we go. The Dow Industrial Average was down 144.67 points, or a decline of 0.42%. The Nasdaq, the loser for the day, down 315.35 points, or a decline of 2.22%. The S&P 500 down 43.97 points, or a decline of 0.97%. The sector's performances were led by utilities, capturing the gold medal, and at number 2 for the silver, healthcare, number 3 for the bronze, defensives. And the laggards of the day, cyclicals, technology, and communication services. The leaders were the ultra-defensive sectors, utilities, healthcare, defensives, REITs. This is a recessionary formation in the stock market. What about the advance? The decline ratios, NYSE 31% advancing versus 66% declining. The Nasdaq 25% advancing versus 72% declining. Commodities down across the board. Believe it or not, the hawkish Fed impacts commodities too. If they're really serious about tightening the monetary policy and causing a recession is not going to happen, and commodities are sky high. They're gonna go down too. The problem is, now that we have a dent in commodities and stocks, which dip do you buy? The answer is obvious, commodities, because they tend to run longer than stocks, but it depends on how soft or harsh the Fed is gonna be in tightening. If the market perceives any dovishness or any weakness in the Fed's approach, you're going to see dips being bought in the stock market again and the Fed having to be more hawkish. But for now, the hawkish tone by the Fed did a lot of damage in commodities, at least today. For example, the WTI was down almost 5%, Brent, on the other hand, was down a little over 4.5%, gasoline was down a little over 3%, and heating oil was down also a little over 3%. Natural gas, on the other hand, closed in the green, be it well below the highs. Nat gas was rallying by the tune of over 5% today, yet it closed the day with gains of almost half a percentage point. Softs, the decliner, lumber, down over 6% today, massive decline for lumber. Likewise, coffee, cotton, OJ, all took it in the chin today, while sugar closed pretty much flat. On the other hand, cocoa closed the day with gains of 1%. Metals, muted activities for gold and silver, but we have declines, big ones, led by palladium, down over 2%, copper, down almost 1.75%, and then platinum, also down almost 2%. Meats, rebound day, but not a lot of gains. Modest gains across the board, live, feeder cattle, lean hogs futures, all barely in the green. What about grains? Modest declines across the board, soybeans, corn, wheat, rough rice, canola, all in the red, but the declines are modest in grains because the tailwinds are still intact. Fed or no Fed, the tailwinds for grains, the shortage of supplies, fertilizer prices moving higher, all of these are solid tailwinds for grains to continue to move higher. The winner of the day was oats, scoring almost 1% gains today. And by the way, remember last year when I was talking about my horse manure business and I told you guys if you want to invest in it or not? None of you invested in it, and it's your loss, geniuses, because in the US, manure is a hot commodity now amid the commercial fertilizer shortage. You want to have a solid bet? Buy calls on manure. Moving on to the options market, the big casino, what's going on today? The hottest table by far is Apple at around 1.25 million contracts traded today. About 58% of those were calls. At number 2, Tesla, the souffle, with around 650,000 contracts traded today. About 59% of those were calls. At number 3, Nvidia, down big today, but perhaps somebody's betting for a rebound here because about 550,000 contracts traded for the name today. About 57% of those were calls. Moving on to the unusual activities that took place in the options market today. And for our beloved European viewers, you're not going to like this because they're betting on massive declines in European equities. We start with the ticker FEZ. This is a European ETF, and they're betting for massive declines to come by buying the 34 puts for the expiration date, May 20th, with the expectations that the name could drop down by more than 15% by then. They paid around 40 cents a piece to enter this trade, all in all spending around $850,000. What about the ticker EFA, another European ETF? Guess what? They're buying puts on this one too. Now, if you want to bet against European stocks, there are many ETFs that you can use. This one shouldn't be one of them because the spread is just too wide. But regardless, they bought the 69 puts for the expiration date, April 29th, with the expectations that the name could go down by more than 5% by then. They paid around $2.50 a piece to enter this trade, all in all spending around $2 million. What about the ticker BTU? This is a coal miner in the US, and the name is surging higher, and the reason is the dumb sanctions against Russian coal by the European Union. It is actually pushing coal prices higher. In this case, they bought the 29 calls for the expiration date, May 20th, with the expectations that the name could move higher by more than 15.5% by then. They paid around $2.20 a piece to enter this trade, all in all spending around $2.5 million. What about the ticker VJK, another European ETF? And guess what? They're buying puts in this one too. In this case, the 58 puts for the expiration date, May 20th, with the expectations that the name could go down by more than 6% by then. They paid around $1.20 a piece to enter this trade, all in all spending around $1 million. What about the ticker ENV for InvestNet, another software name, believe it or not, holding a lot better than the rest of the software names in the market, but it popped higher today and somebody's betting for more gains to come. In this case, they bought bought the 100 calls for the expiration date, May 20th, with the expectations that the name could score gains of more than 24.5% by then. They paid around $2 a piece to enter this trade, all in all spending around $1 million. And lastly, what about the ticker VOO? This is the Vanguard 500 Index, meaning you're betting for or against the stock market. In this case, they're betting against by buying the 375 puts, the expiration date May 20th, with the expectations that the name could drop down by more than 8.5% by then. They paid around $3 a piece to enter this trade, all in all spending around $1.5 million. Moving on to the heat map analysis. A sea of red, specifically in the northwestern side of the map, which happens to be the retail crowd's favorite side. Bloodbath in Chinese equities, Tesla, the cyclicals, banks, financials, industrials, even materials are down. Bloodbath across the board. What's working today? The ultra-defensive sectors of the market. We're talking about utilities, REITs, some energy names, defensives, staples, the actual defense names, the likes of Lockheed Martin, for example, and the healthcare, also another defensive sector of the stock market, specifically the big pharma and the big insurance names, meaning the market is tilting toward dividend names and highly defensive names. And the evidence is, look at the contrast of performances between any restaurant names and McDonald's. McDonald's was in the green. Chipotle, for example, was down big. Chipotle is a growth name. You buy Chipotle when the economy is growing, when the Fed is loosening, but you buy McDonald's when the economy is about to head into a recession and the Fed is tightening. McDonald's, believe it or not, fared a lot better during the crash of 2009. We have some notable movers with some news, like Uber, for example. Uber was down big, almost 4.5% in the downside today. Even though the company came out and announced more services, shall we say, that you can now book trains, buses, planes, car rentals in the app this year. I say good luck. Good luck finding drivers with the insane gas prices. The margins are going to get crushed, folks, like it or not. We also have the Twitter saga. We now know that Reverend Elon Musk has been buying Twitter stock since January, and the stock was actually going down. So you have the richest man in the world buying the stock, and the stock keeps going down. But when the announcement that the richest man in the world has been buying Twitter comes out, all of a sudden the stock pops. Really? So the news of Elon Musk buying something is better than him actually buying something? This is the kind of stupidity that we have in the stock market right now. The excess that has to be flushed down. The scams of this man. This is yet another scam from Elon Musk. As if Bitcoin, Doge, Shiba was not enough, now they gotta go with Twitter. He made a ton of money from the pump, and he's not gonna protect shit, by the way. If you really want to defeat censorship and protect free speech, you could have easily created another alternative social media platform. But buying Twitter is just another gimmick from the Rev to get richer and give you the illusion that he's actually fighting for free speech. Now, I'm not that dumb to fall for it, but millions of people around the world are actually falling for it. He's a master manipulator. You cannot deny that. Anyhow, moving on to the heat map for the ETFs. Again, bloodbath, specifically in technology. Look at the TQQQs, for example, down over 6% today, while the Qs are down a little over 2%. So you should be glad that you bought the TQQQs, right? But technology was not the only victim today. Consumer cyclicals were down big, the XRT retail down big, the XHB home builders down big, any financials down big, growth in general down big, international markets down big. And what's working? REITs, IYR, VNQ, utilities, XLU, staples, XLP, healthcare, the big pharma names, XLV, energy somewhat, XLE, the VIX proxies, the inverse indices. Some of the commodity names are working, not by a lot. Silver, gold, for example, natural gas, UNG. But besides that, folks, the choices are becoming limited. Moving on to the charts analysis, and we start with SPY. This is a 30 minutes chart for the S&P 500. We have a gap down. The bears are showing up now, but look at where the SPY caught support from. The gap at around 444.42, which was a gap before then. It was an important support. We have 443 as support in this chart, but that gap was important. The reaction to fill the gap and rebound from that point on told us that 444.42 is important. And today the chart went down. Look at that. If we extend the line, it went down precisely to 444.42. And it was a battle between the bulls and the bears. But at the end of the day, the chart closed within a tight range. Why? Look at the RSI indicator, for example. It was severely oversold. So even though the bears wanted to hit the SPY and the broader indices, they could not do so because the technicals were severely oversold. If the chart was bullish, if the bulls were still in charge, they would have taken advantage of the oversold technicals and attempted to close the gap. That did not happen. From a behavioral chart perspective, I see that as weakness. I see that as just a matter of time. These technicals are being worked out. They're becoming from oversold to normal, which means now the bears have the ammo to hit again, and sooner or later the SPY will lose 444.42 and then some, maybe 443. Most important line here. So the bulls must start to fight back tomorrow. How could they do that when you have Bullard speaking, more hawkishness? So I see the bears turning the table here and regaining control. Here's a daily chart for the continuous contract for the SPY, the S&P 500. We're now starting to see more damage done. The good news for the bulls, they're still holding 4,472 as support. The problem is, on the daily charts, we don't have any oversold conditions at all, which means, yes, you could see bounces maybe tomorrow, maybe on Friday, but sooner or later, this chart, if the bearish momentum continues, just look at the momentum indicators, the RSI, the MACD, they're curling their way down in negative divergence. The volume is moving higher. All of these are indicators that the sellers are back, the bears are back. Sooner or later, this chart will lose 4,472 as support, but the most important support is down there at 4,384.5. If the bulls lose that, they got a major problem coming. And give us the SPX, the cash index. Let's take a look. And ooh. Oh, no. The chart's now down below the 200 days moving average. It got rejected clearly from 4,590, and now it is down below the 200 days moving average. Whoops. If it closes that way for the week, we got a major problem for the bulls and an encouraging sign for the bears. Moving on to the Qs. This is a 30 minutes chart for the NASDAQ. Another gap down. We knew ahead of time that the support in this case will be 352. The battle of 352. An epic battle between the bulls and the bears. Now, how do we read this one, by the way? Because the bulls built a fortress, a strong defense at around 352 by retesting it over and over and over again in the past. So we knew it's going to be a tough battle here. But what really saved the bulls today from losing 352 was the oversold reading on the RSI. So the technicals could not sell more. But the problem is, again, the bulls, if they were confident and they had conviction, they could have used the oversold condition by rallying at the end of the day and attempting to close the gap. They didn't even do that. Once again, folks, from a behavioral chart perspective, I see that as weakness. I see that as once the oversold conditions are worked out, the bears will hit again, and sooner or later, the chart would lose 352. We will go down to the battle of 343. Here's a daily chart for the continuous contract for the NASDAQ. The good news, once again, for the bulls, they did not lose 14,445. The bad news, the volume went higher. The momentum indicators are now in negative divergence. That tells me sooner or later, the bulls are going to lose 14,445 regardless of the bounces that we're about to get. The most important support for the bulls is 14,000. What about the IWM, the Russell 2000, from a 30 minutes perspective? We knew the moment you lose 204.5, matter of fact 203, the shorting signal is in. And now we got the gap down, and it appears that the IWM is consolidating in a bear flag pattern, wanting to go down all the way to the next support at around 196.5. Now, the chart is getting, or was at least, oversold, so it could bounce higher. The bulls could attempt to bounce. The problem is, are they going to be able to close the gap, number one? Number two, even if they do close the gap, can they reclimb 204.5? I doubt it. But if we have a rejection at that point, it is another signal to double down on the shorts. Now, there is the other scenario that we could see a gap down and a sell-off right away in the morning tomorrow. If that happens, we will watch 196.5 and the behavior of the chart at around that number. Now, what I want to do is visit the weekly chart for the RUT, the Russell 2000, because we were talking over the weekend about the important level of 2100 and the battle between the technicals and the fundamentals. The technicals appear to be bottoming when we talk about the negative momentum. And perhaps, we were discussing at that time, perhaps the Russell 2000 will make it above 2100. But the logic and the fundamentals say otherwise. The fundamentals say the Russell should be down, not up. And now we know the answer. We got a rejection at around 2100 once again. I doubt the Russell 2000 will make it above that line by the end of the week. And look at this, we're back in negative divergence in the momentum indicators once again. The Dixie A daily chart, what's going on here? Still strong, not going to bet against it, not going to say that the Dixie's not going to make it to 100 because this is the psychological level right now and they're going to push it all the way to 100. It has a lot of support, a lot of fundamentals to go ahead and tackle 100. So we're not going to fight the dollar right now. What does that mean, by the way? It means that the gold bugs are going to be on pins and needles. They're going to be nervous as hell because if the dollar pops higher in a significant way, it could take down gold with it. But look at the resiliency, folks. We're talking about the dollar and the 10-year yield popping higher together, the two enemies of gold. Yet gold continues to hold on. This is, and I say that pretty much in every night, it is a sign of strength that gold wants to go higher. It is just waiting for the green light, and the green light would be a top in the dollar and the 10-year yield, at least a short-term momentary top. What about oil? Brent, it failed the test of 105.84. It failed to break above and hold the sloping line of resistance. And we have some bad fundamental news for oil. Number one, the release of the SPR. Number two, the allies of the United States are now releasing 60 million barrels from their strategic reserves. On top of that, the Fed piled in with the hawkish commentary. But look at the damage so far in this chart. Not a lot. All in all, in the grand scheme of things, not significant damage. That tells me that we have another run higher in oil. When will that happen? I don't know. But the story is not over for crude oil because the dip will be bought. The question is, which dip? Commodities or stocks? And if the Fed appears to be a little soft, a little behind the game, a little wait and see kind of approach, you're going to see commodities rebounding higher before stocks. And here it is, the 10-year yield, the daily chart. It is on a breakout, now securing 2.54 support. So bond bears have a cushion in 2.54. The question you might be asking right now, why are banks and financials like regional banks, for example, doing awful when the 10-year yield is spiking higher? The answer is the yield curve. The 2-year is also spiking higher. We have an inversion in the yield curve, meaning banks are going to lose money. Banks make money when we have a steep yield curve because they lend you today and they expect you to pay later and for that interest rate to move higher in the future. This is not what we're seeing right now. We're seeing an inversion. 2-year paying more than the 10, not a good environment for financials. What about the TLT, a weekly chart? Oh no, it lost 128 to support. Bad news for the TLT bugs. If it closes the week below 128, we have another flush down coming and another massive spike in the 10-year yield. What about the VIX 4 hours chart? We talked about the saucer bottom. The VIX is now firmly above 20. It gave it a shot to try at 24.29. It did not make it, but I see the behavior as recocking the gun to give it another shot and blast above 24.29 again. Why do I say that, by the way? Look at the MACD indicator. It is firming the positive momentum. We're seeing more green impressions on the histogram. Likewise, when we zoom out to a daily chart for the VIX, what are we seeing right now? Yes, it is a reverse hammer / maybe a shooting starish kind of pattern when we talk about the candle, but look at the momentum indicators. They're bottoming, folks. They want to shoot up higher. It has been a massive drop for the VIX top to bottom. You're stretching that rubber band. Guess what's going to happen? There is a reaction to that. And that reaction would be the VIX blasting higher. It couldn't make it today by closing at the highs of the day, but who's to say that the VIX is not going to give it another shot and blast higher again? Folks, the opportunity to start hedging is right now when the VIX is cheap. Once the VIX starts to climb to 30, 35, 40, those put options are going to be really, really expensive. What about the VXN, the VIX for the NASDAQ 4 hours chart? Again, popped above 27.5, an important line. This is a major victory for market bears, the NASDAQ bears. And when we look at the MACD indicator, for example, it is firming higher. The positive momentum is accelerating, meaning we will see more gains for the VXN, more losses for the Qs. And here's the king of the Qs, Apple. Apple closed below 172.4. It lost an important support. We now have to look down at around, let's say 169, which happens to be the upper edge of the channel in yellow. And if that is lost, we're going down to 157. Look at the volume. It is moving higher on a selling day. The MACD indicator, the RSI, all of these momentum indicators are curling down back into negative divergence. Not a good sign for Apple. And if it is not a good sign for Apple, it's not a good sign for the NASDAQ. What about Tesla, the Soufflé hourly chart? We have a gap down. Now the chart lost 1,090.5. We have bag holders, these FOMO morons, they're losing money now, and the chart is consolidating in a bear flag pattern, but it is getting a little oversold in the RSI, at least from the hourly perspective, so we could see an attempt to close the gap and recapture 1,090.5. In all likelihood, it's not going to work because the psychology is going to be supreme. We have a batch of buyers already losing money. Soon enough, we're going to see more people losing money. And if the chart loses 995 as support, we're going to have a lot of bag holders who are going to sell and book the loss before these losses accelerate. And that will prompt the early riders who bought the dip at around 700, 800, 900 to start to panic and say, you know what, we better book profits before we start holding bags too. And that will exacerbate the losses in Tesla. So 995 is an important support line for the bulls to keep. What about Bitcoin? Tulips. We have the Tulips Festival in Miami, yet it did not help BTC to move higher. And it appears that the bull flag is melting down. We'll keep the bull flag so long as 42,000 is intact. But here's the problem. When we zoom out to, let's say, a weekly chart, for example, all in all, this pattern is a bear flag pattern. And the MACD indicator is curling down. The RSI is also curling down, indicating weakness. There is still hope for the bulls, but they gotta start buying now for that mini little bull flag to play out. Otherwise, the larger pattern, the bear flag, will play out. If that happens, we will see BTC down at 10,000 sooner or later. Why? Remember what Dudley said, to tighten financial conditions, you have to crash stocks. It's inevitable. A lot of the excesses in the economy that we have right now is due to the rise of Bitcoin and tulips. So tightening those financial conditions means that the Fed wants to see this chart crashing. It hurts them when stocks crash, but not when cryptos crash. So watch out here. And by the way, if you did not pay your taxes, you're in for a surprise. Even if you lost money in tulips, you're gonna owe taxes. So watch out for the big guy. Lastly, what about AMC, apes? What's going on here? They lost 21. The chart is becoming severely oversold, so it is ripe for a rebound. But will the apes buy calls? Will they buy the stock right now? They're obviously discouraged after the massive dump from 32 all the way down to 21. And with all of this hawkish talk, by the way, what do you think the Fed wants to see AMC at? Maybe at $5? $2? Because we're going to flush down all of this excess and speculation in stocks, and this is the king of speculation. That doesn't mean that we cannot have a rebound in the meantime, but the apes better start buying, and they better close the week above 21 to keep any hope alive. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have initial jobless claims, but most importantly, we have some Fed zombies speaking, among them the Bull Slayer, James Bullard from St. Louis. What is he going to say? We also have Charles Evans, the king of doves right now, perhaps the only remaining dove. So it is a dove versus hawk kind of fight tomorrow, but the market cares more about Bullard. The market never cared about Evans. Nobody cares about Evans because he's a pumper and he's going to continue to pump. Nothing new here. And lastly, we have consumer credit. Let's see how that looks like. And with that, folks, I'm done here. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.